Hello everyone. I have no idea why I'm doing this, but let's do it. So I'll solve the BNL. I'll try to solve the BNL and GENMO from scratch. Let's hope it's gonna be not that much long. That's what she said. Anyway, uh, let's start from the cash flow. So here we have already operating income, right? But we know in operating income interest expense should not be there. It's maybe from because this is US company, we have interest expense inside operating income. So let's add that back. Come and I think we don't need 18, 19, 20, so let's delete it. It's just you can just do that thing, you know. I don't know what that is. Just increase the formula bar. So let's do it fast. Okay. Yeah, so interest expense a bit we will get, which is plus this depreciation amortization depreciation, yeah, and we'll get a bit equals to, now comes the accruals. Yep, accruals. So first is receivable, this thing, so that got increased. So now we owe more money. So that is bad for cash flow. So negative cash flow. So it should be negative. So this minus this. Then inventories, it also increased. So again negative. Prepaid expense. I don't know why it's getting paused. I have no idea how much it was skipped. So yeah, so cash flow from operating is this much. So after that, we have paid income tax. Tax paid. It should be uh provision for tax. It's in positive, so income tax paid is this, and then here related to income tax payable. Yeah, income tax payable increased, so we held up some money. So income tax payable, we held up some money. So plus this minus this, and then deferred tax also same. We held up some cash. So this is the income tax paid. So net cash flow from operating this minus this 93,239. Let's see, 93,239. Yeah, we are going good. This is operating. Now let's do investing. Yeah, so in investing we have to do PPE. So we have to do one is from other asset and another one is PP, I can see. I think for other asset, proceedings from other asset, we can write proceedings from other asset is, so other asset got increased, yep, and other income is also there. So because other asset increased, that means cash decreased, right? So this minus this plus the other income, which is minus 19,973, and 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 for PP. So for PP, what is the, I'm not sure why it's getting paused. Let's do it the financing terms. Okay. For financing, short-term notes payable, net short-term notes payable. So payable decreased, so cash outflow. So this, this. So basically you can think of it as a liability. So liability for always 17 minus 16. Then LT debt, it increased, so cash inflow, or you can think 17 minus 16 because it's kind of a liability or asset. Sorry, liability or equity. Other liabilities. Other liabilities, I don't think it should be here, right? Okay, I think other liabilities can be here. I guess it's kind of a like date only. So it got decreased. So cash outflow. So this minus this. Okay, these are here from here. And then capital got increased. Net share capital, which is good news. So cash inflow. And then think, so these three happened. Okay. Other liabilities also done, share capital also done. Now we have to think from here what's left. Interest expense. Okay, yeah, interest expense is a financing activity equals to minus this got, we've spent it, so minus. Then operating income, other income, net income, dividends. Yeah, for dividends is financing activities. Dividends minus of this. Now the net is, so total net, this is financing, net financing, net cash flow equals to this plus this plus this. So it should be 107409. Okay, it's 107409. So it's done. Now I think there were some, yeah, this ratios, right? Let's try doing that. I'm just gonna paste these values and delete the answers. Profit margin equals to gross profit by revenue 32.43. Is it correct? Yeah. Okay. Net profit margin equals to income, net income after tax by Sales 2.55. Return on asset is kind of a tricky for this one, I remember, because we have to uh, calculate PAT plus effective cost of interest. So first, let's calculate the tax rate, which is provision for tax by net income before tax, right? So, so tax rate is here. So, so the thing is to calculate the return on asset. So in the below section, it will be asset, total asset, right? In the upper section, it should be PAT plus effective cost of debt. So what is effective cost of debt? I think I calculated it. So let's say two companies are there. One is 1 lakh total equity and one other company with 60,000 equity and 40,000 debt. Now, first company for both the company operating income is 40,000. Okay, from 1 lakh, 1 lakh they earned 40,000. Now, because of interest expense, its PBT will be 36,000 and but its PBT will be 40,000 only. Now, let's say the tax is 25%. So 40,000, 25,000 is tax, 10,000. So profit after tax is 30,000 for this case. Now for this case, 36,000 is PBT and tax will be only onto this 36,000, which is 9,000. So PAT will be 27,000. But the return on asset is not 27,000, right? Because we have to calculate this 30,000, like this should be the right amount. So we have PAT. Now we have to add back the effective cost of debt. So because of we took debt of 40,000, how much it costed us? Cost, I don't know costed is the correct English or not. So because of 40,000, how much it costed us? So because of that interest expense, we have given 4,000, right? So you can say that 4,000 is our cost, but that's not it. Because due to that 4,000, we are giving tax less 1,000 less, because if the interest expense was not there, we would have to give 10,000 in tax. So effective cost is 4,000 minus that 1,000 equals to 3,000. So how to calculate that? 4,000 into 1 minus the income tax. So that will give you 3,000. So you will get the total return asset. So in this case, it should be the upper hand section should be PAT plus 1 minus this into rate interest expense, which is this. Let's, I don't know the order system here. Plus so return on asset should be this by total asset. How much is total asset? This value. Okay. Return on equity is PAT by equity. Equity is this value, I suppose. Uh, it should not be it. Is it? No idea. Let's see. No, return on equity is not that much. It should be return on equities. Return on equities. Okay, this plus the retained earning also. It comes under equity, dividends and retained earnings. Sorry about that. So inventory turnover is Inventory by cost of goods or cost of goods by inventory, one among them. I think it's inventory by COGS 0.32. Nope, it's the other way around. It's turnover, inventory turnover, right? It's a turnover by inventory, total asset turnover. So it's turnover by, sorry, turnover by total asset 1.46, is it? Yes. Now days receivable is basically receivable divided by receivable is related to sales. So sales into 365. Inventory velocity is equals to inventory divided by COGS into 365. Days payable equals to payables, days accounts payables divided by COGS, because payable is of the cost of goods sold, right? So that's the reason. And including this, it should be 365 into accounts payable plus short-term payables divided by COGS. Current ratio should be current asset current asset divided by current liabilities. Sorry, current asset by current liabilities. 1.75. Yep. Quick ratio is cash and cash equivalents by current liabilities. I think this is it. 0.1. No, quick ratio is cash and cash equivalent. Okay, cash and cash equivalent. Here accounts receivable also should be there, right? Yeah, because these are easily accessible. Prepaid expense we cannot get easily, and inventories we can. So yeah, operating cycle is, I think it was days receivable plus inventory velocity minus days payable. 105.42. Let's check. 105.42 debt to equity here. Total liability by equity 1.9. Non-current liability by capitalization expenditure. Non-current liabilities are, these are current, so these are non-current. Non-current liabilities by equity plus debt. 0.32, is it correct? Yep, thank God. Long-term debt by equity. It's straightforward. Long-term debt by equity. Interest coverage ratio is interest expense by what? I think it's should be current asset, or I don't remember. 0.02. No, it should not be that. Interest coverage. Okay, it's given. T. TYE. Okay. It's it's okay. It's yeah, that I think it is. Let's check. It's O4 by V7. O4. Okay. Operating income. That was a tricky one. Operating income. What is our operating income? This by interest expense. Okay, this three-way, I think it was given as return on equity 10.81. We can calculate. I am not doing this. Done, I think. Yep, let's end it. And should I do the other one? Let's do it. So for the Genmo, I don't think I have that clear template, but I tried to creating that as much as I could. Let's begin and let's complete it in 15 minutes max. I am fed up with it. So first it was given revenue is 10,288,1, and I think one thing was given which is current liabilities, which was 2285, right? This two was given. Now acid test ratio. Acid test ratio means quick ratio, which means that quick cash or cash equivalent, cash or cash equivalent is this into current liabilities. So this. So I think these three, sum of these three should be 1533, right? Right. So okay, 1533. Let's write it. Okay, now current ratio 1.172. So current asset equals to into 2678. So current asset, total current assets should be 2678, should be this value. Sorry, this. Okay. Now, now, so inventory and prepaid expense should be this minus this. Okay. Now, the next one is inventory turnover. Inventory turnover means, okay, so first let's calculate the gross margin because for this we need cost of goods sold. So gross margin is 15.5%. So which is, so the thing is, we know, can we write here? Yeah. So we know revenue, COGS, sorry, gross, sorry, gross margin equals to, no, whatever is the gross margin by revenue is 15.12. So gross margin should be 15.12% means 1.1512 into revenue. Okay, so where's my calculator? Okay, let's multiply here only. So this should be this this into 1554. So cost of goods sold should be this minus this, right? Then net margin should be cost revenue into 2.09. Sorry, 2. Not 2.091, the 2.03 into what is the net margin? Yeah, this value 291.06. Okay, so there's that. So this net income should be 15291, but it's now 1554. So this value should be here. We'll do that later. Invested capital turnover, which is, if we know, it's turnover by debt plus equity, right? So invested capital turnover is 2.091. So it's basically revenue by debt plus equity. Debt plus equity is capital expenditure and revenue. So it is given as 2.091. So debt plus equity should be revenue by this value. So I can say debt plus equity equals to revenue by 4916. Okay. And now it said that 62% is debt. So debt equals to 1.5 into debt plus equity, which is 305, and equity is equals to minus 30. So 1861, and ROE should be then 291 by, sorry, there is some mistake. Debt to equity ratio 62.15. So debt to equity, yeah, debt to equity is 0.62. Okay, so debt should be 0.62 of equity. So debt plus equity is 1 point. Debt plus equity is equals to 0.62 equity plus equity. So 1.62 equity, which is given that 4961. So total equity should be, sorry, this is wrong. This is also wrong. Total equity should be this by 1.62, 0.15. So 1 plus this value, and debt equals to be this minus this. So ROA is 9.6. Yeah. Ah, okay. Now we have all the values, but we have not taken one. Days receivable 39.66. So days receivables means receivables by revenue into 365 equals to this value 39.66. So it will go there. 39.66 by 365 and receivables would be 9.66 by 365 into revenue. So receivables should be 39.66 by 365 into revenue, which is 1170, 1117, right? Receivables, yeah. And after this comes some tricky things. So, according to our teacher, companies uh, keep cash in a certain ratio. So, they keep cash in the ratio of cost of sales, I think. So, it should be the ratio is 18 by how much they have paid in a whole year. So, it should again be the same ratio into this year's cost of sales. Sorry, so this into, sorry again, it's cost of sales to cost of sales. So 19.24 or it was revenue. Let me check once. So it was given us, okay, it was on revenue. So he said that it's depends on different company. I'm not sure. So this should be, and then this should be in 33 minus 18.92 minus this value. So 396.97 inventories and prepaid expense. This again, I think again we have to calculate some ratio. Okay, inventory turnover is given. Sorry, inventory turnover is given 10.005. So inventory turnover means revenue or cost of goods sold. Sorry, COGS by inventory equals to 10.005. From here, you can calculate inventory equals to COGS by 10.005. So 872.72, is it? Yeah. So this should be 1145 minus, and now this, let's see if it's this or not, minus sum of, yeah, 0.00. So it's matching. So it's good. Now, investments. I think then again you have to take some assumptions such as amortization is same, depreciation is also is same, or something, I don't know. Let's check. So yeah, we have taken that PPE and depreciation and everything should be similar because there is nothing mentioned. 4727 is PPE given. Depreciation then again should be then accumulated depreciation plus this year's depreciation. I mean, because it's negative, then it should be minus 2776, right? 2711, okay. Okay, it's 278. How is 343? Okay, sorry. 278, J36. Okay, now net book value should be this minus this. Sorry, plus we have to do it's positive. Okay. Now special tools and goodwill. I think this should be special tools and goodwill should be again in a ratio of something. Yeah, special tool is we can check what is left. So yeah, so total liability and equity. We have equity, right? Total equity is 3032. This value, and then we have the debt also, which is 1884.541. Now I think yeah, we have taken that other non-current liabilities are not changed. What's that? Other non-current liabilities are not changed. So long-term debt should be this minus non-current liabilities 933. Yep. And there are certain assumptions. Forgot, yeah, the stock. There is nothing written as stocks. So these two are similar. Those three are only similar. We have taken. And then special tools should be this two value are amortized, right? So this was the total value of it. 343, I think. Yeah, so now its current value is around amortization is happened in that. So 422. Now it should be in the same ratio. So the upper section is a ratio. We just divided in the same ratio. So it should be 422 into, and this should be the difference. Total asset then should be total current asset plus PPE plus net book value plus this. Yes. 9384. Sorry, no PP should be there, right? Because we have to take the net book value. So 9 we cannot consider. 5116.2, is it? Okay, investment we have taken as, now we have to take investment for the other value. So that is okay, so we don't know the investments. So and from here we know current liability is 2285, right? And this is long-term debt. So total liability we know is this plus this plus this value. Okay, I'm done with accounting. Yep. So where we total liabilities is given, total equity is given 3032. So total liabilities plus equity is this plus this 7201. Now then investment should be 7201 minus this value 2086, and this should be plus of, okay, we cannot add, I think. Yeah, so we can calculate and write it 2086, it's there, right? So just write 2086 and here add that, so it would look good. 702. Okay, just copy it, just copy it, paste the value. How to paste the value? Yeah, paste the value. Now 6, remove it and write equals to this value. And now add that back, so they should be similar to 01.79720778. Okay. Okay, these are similar. Okay. Now 2285, how we have to divide it is, I have forgotten. Again, we have to take some ratio. I think account payable by cost of sales. I think, yeah, account payable by cost of sales. And then we should multiply it by the current year's cost of sales. We can take other formulas too. It's just what you think relevant is. Loans payable, accrued liabilities. Again, I think we have taken for accrued liabilities revenue. Accrued liabilities, you can take, it is on revenue and then calculate it. You also can take sales also, it's fine. And this should be 2285 minus this minus this. So now we have all the values. Retained earnings should be to 3032 minus this minus this minus this, right, equals to this three should be equity. Okay, so now SNG admin expense and provision for income tax. How we have calculated it was SNG, I think provision for income tax we have calculated as tax rate we have calculated. Okay, tax rate we have calculated as last year's tax rate. Okay, we have calculated last year's tax rate, given that income tax how much and the income before tax was how much. So income tax was 163 and income before tax was gross margin minus this minus this minus this. So this was the interest expense. So okay, so this is the income tax. So now we have net income should be minus sum of these, all right, 933. So the difference is, it's 642. So there should be some value. After that, we should, after removing this, if we are calculating tax, and after that it would be, if we remove the income tax, that should be 291.06, right? So how to calculate this value? So we can see the net value is now 933, right? So one value is x, right? Remove this. So one value is x, another value is 933 minus 291, 642 minus x. So let me just show you. I think it's getting complicated. So yeah, so how I have calculated it is remove the gross margin from the gross margin, the other expenses. Okay. Then calculate the earning before tax from here. So if you see 291 was the net income. So what was the net income before the interest expense, like profit before tax? It was 291.06 into something by, so it was basically x was the profit before tax and x minus x into, so profit before tax, and it was 118 equals to 291.06, right? Sorry, 118 not given, so we have to find it. X is given, 291 is given, and it is said that profit before tax is x. So what is the profit after tax? X minus x into zero point 0.3, let's say. So 0.7x equals to 291. So x equals to 291 by zero point 0.7. So what this zero point 0.7 is? 291 by 1 minus zero point 0.3, right? So from that we can get the PBT, which is 291.06 divided by 1 minus this value, which is 409. Okay, so 5, so 409 is the value, which should be 15 minus sum of this number should be 409. Yeah, see, these are same. So we know that the other numbers summation should be, from that we know it should be 15 minus 409. So 1144. And from that it was given, it was we assumed it is same, it was we assumed it is same. So what is left? 523, that we have just put down. So this is the calculation. I think I just made it complicated. But yeah, then it's done. Then for the cash flow, we have PAT, then taxes. We have written here, just write it down. Operating profit you will get, depreciation and amortization. You can write it down, just add this up and add. You'll get EBITDA, accruals. You can just write the changes for accounts receivable and everything. And then cash generated from operations you'll get, taxes paid, negate this, and you'll get net cash from And investments, you have to do for the investments. Where is investments? Investment, yeah, change in investment. And we took that no, you know, nothing changed in PP, so the changes investment is bigger now. So we have done more investments, so negative cash flow. Short for financing, short term loans repaid. Where is it? Short term loans repaid. Think it is given at loans payable. Yeah, I think it's short term loans payable, which got decreased, so we paid some money, so the difference is around 58. Yeah, that is a negative loan taken long terms. It's increased a lot, so positive cash flow. And how did we find the dividend paid? Is we check what is the change in uh, earnings, which is minus the last year's earnings. It is 80, but the net income is 291. So the other 200, whatever the difference is, went to dividend. So if you check 291 minus 80, you will get the value which was given at dividend. And we have paid it, so minus 211 outflow. You will get the from the financing, then add them up, you will get net cash flow. The last year's was for 18 into 494. Marketable securities is cash equivalent, so 512 minus 96, you will get 416. And if you add this up, you should get the same. So that's it. Bye bye. Good night.